Hi, fellow freelancers. I'm Dave Desario from the Freelancers Union. I work on member organizing and advocacy, and I'm a freelancer, of course. For those of you who are unfamiliar with the Freelancers Union, it gives its 375,000 members a powerful voice through policy advocacy, offers benefits, and builds community. And it's free, so there's literally no reason not to sign up. I'd like to thank you all for joining us for today's webinar, Practical Ways Freelancers Can Increase Their Savings. This webinar is co-hosted with Alliant. They've teamed up with us at Freelancers Union. Alliant is a credit union, which means they're owned by their members, and they're online, which means they're available nationally. And as a member of Freelancers Union, you're eligible to join. So you can find out more about Alliant and the services they offer freelancers by clicking the link below. It's myalliant.com/freelancersunion. Now, as freelancers, we have unique challenges when it comes to our finances. We're running our own business. Our income can vary a lot from month to month, and we've got to be experts on what we do, which usually doesn't include being an expert on managing money, myself included. So we're here to help. Our webinar today with Alliant will be less than an hour. We'll get started with a presentation and overview, during which time you can ask your questions through the chat box, stay on topic during the presentation, and then at the end of the presentation, we'll open it up for your more general questions for our expert. Now, we're very fortunate to have Michael Skay from Alliant presenting to us today and taking our questions. Mike is a personal finance professional with over 20 years of experience in money management, lending, and financial advice. Over the course of his career, Mike has advised personal and business clients of ways to become more successful financially and to grow their wealth. He's been invited to speak for companies like Google and at national conferences for the Association of Legal Administrators and the Society of Human Resource Management. So welcome, and thank you for joining us today, Mike. It's great to have you here with us.
Thank you for having me. I'm looking forward to this.
And so, folks, we'll get started. Michael's going to get started with a presentation, and you can ask your questions. I don't know which way is right or left on your screen, but in the chat box on either side, and I'll help get those questions to Mike as the presentation is going. So try to stay on topic, and I'll relay those questions to Mike during the presentation. And then after he's done with his presentation, we're going to open it up for your more general questions about savings and about finance. So we'll get started whenever you're ready, Mike.
I'm ready. All right. Thank you. Hello, everyone, and thank you for joining me today. Now, when you decided to be a freelancer, you obviously decided to be a business owner. And like all business owners, whether you're starting out or you're well established, you're hyper-focused on delivering a great product or service that generates revenue, right? Generating revenue can be overwhelming early on. It can be an overwhelming focus, and it can be all you end up focusing on. But what happens when you succeed at doing that on a consistent basis? What's next when you have revenue figured out? Well, what's next is a good problem. And so how do you effectively use that revenue to drive your business and personal financial success at the same time? Now, I've worked with many clients over the years who are business owners, and they end up driving the business, and they never quite get around to driving the personal financial success. And those are some of the things we're going to talk about today. We're going to look at strategies and topics that each freelancer should have in their toolbox to make sure their business and their personal finances are sound. We'll talk about budgeting on that irregular income. How can you possibly do that, right? How to get your business to feed your goals instead of just feeding your business. That's the step you want to take out of your business, right? That's some true success. And then building the right savings buckets for success. In business, we typically allocate money by what expense it's for. We put money in buckets naturally in business, but we rarely do that on our personal finance side. And that's going to be one of the topics I talk about today in a strategy. And then looking to the future. How do I generate revenue now, handle the workload now, and then look towards the future goals I have in personal finance?
Okay. And Mike, just as we get started, I was wondering if you can make this deck or some of these slides available for folks that are watching.
I certainly can. Yep, we'll
Okay.
make sure that we make these available to you.
Thank you. And then as we get going, you did a good job framing things there. I'm just wondering, as a financial advisor, when you meet a freelancer, what are some of the common issues you might expect to see in their finances in the big picture that they might need some help with?
Sure. So some of the big picture items are, you've built your business up, you're generating a good amount of income, and now it's time to go to the next level, right?
Hmm.
Um, so you only have so many hours in a day. You only have so much revenue coming in to grow your business. How do I either borrow to grow there? And then what do I need to do well ahead of that point to be able to borrow later? So the idea would be, I'm going to need to expand in a year or two. What should I be doing today to set up for that? And that's one of the things I always have tried to drive home with freelancers is, how do you start to build that savings? And then also looking at it from a different angle than your accountant. How do you start showing some of that income so that you can borrow later? And I'll dive into that a little further too, into what it means to borrow and how you should be prepared for that.
Okay, that's great. That's a big question I have too. As someone that's a freelancer, you know, it- there's a scary transition and an exciting one when you're moving from just being a sole proprietor to really being your own business and really functioning in the long term. So I'm looking forward to the presentation, and
All
I'll
right.
I'll get back out of the way. Thanks,
Thanks.
Mike.
Oh, great question. All right. So our first instinct when we earn money, whether you're an employee at a company or you're a freelancer, is to increase that standard of living. And that is an urge that I found in business owners that's even stronger than somebody who's an employee at a company. And one of the reasons I've found that is that freelancers do a lot of sacrificing early on to become successful later. So when that success comes, it's almost like this relief valve, right? Now I'm going to go and do all the things that I've deprived myself of for years. And I want you to consider just letting some of that happen for sure, but also do it in moderation. Uh, as you begin to earn money, be sure to adjust your budget accordingly. Put as much of it as you can towards reducing liabilities and increasing your assets. Um, Staying focused on not having a ton of leverage early on gives you liquidity, gives you flexibility in your business. Celebrate your successes, but be cognizant about whether you're bettering your life in the short term or the long term. But once again, reward success, right? But don't lock yourself into something or take away assets that you could have used to grow your business and been able to celebrate maybe 6 months from now or a year from now what you decided to celebrate today, and it blocks you from that success. So it's going to be a balance of the two, and that can be hard sometimes. Um, a bigger home, a bigger budget on your business, bigger expense line on your business. Those equal bigger liabilities. So how can you stay lean in the midterm to make sure you're saving? And you make sure you make sure to account for those added costs, and it'll affect your future goals. If you miss out on that stuff early, it's going to trickle down later on. All this isn't to say you shouldn't invest in your business. You need to do that. Investing in your marketing, modernizing equipment, your workforce, if you have any, or whatever it is smart for your business. However, you need to be secure for your future and accumulate personal wealth. And one tip I want to give early on is that you need to start doing that right away. Do not push that off and say, I'm going to start saving next year or the year after that, because you get into a pattern of that's how you live financially. So to accelerate your plan, you for financial freedom, you want to snowball windfall. So if there's an unexpected job that comes in and you make more money than you thought you were, put that off to the side. Set it off to the side. Pretend like you don't have it. When I've worked with business owners, I've had them. I do it with personal accounts too. So I've had people run their personal accounts and their business accounts the same way, and that is multiple accounts for multiple purposes. And so let me explain that a little bit. General expenses are going to come out of a general checking account. But if I have something, an expense that's 6 months down the line or a year down the line, I'm going to have a separate savings account just for that. And by separating that money, you do that on a spreadsheet all the time. If you're somebody who budgets, you do it on a spreadsheet. The trick is to take that and actually do it with your bank accounts and set up those separate accounts. Something like a credit union is a great way because you don't have to worry about minimum balances. You can have as many of those little accounts as you need to do that. You can do that from a business side. From the personal side, I have people do the same thing. You shouldn't be operating your money out of one account, even as a freelancer.
So sorry, let me just cut
Yeah.
in, Mike, and I'm sorry, I didn't mean, I'm not setting this up as an intentional plug. I have a bank account with a large bank whose name ends in the name of a country, and I use one checking account because I've got I have to maintain a $1,200 minimum balance, and if I fall below that 1,200, I think it's a $12 fee per month, something like that. So I keep it above that. What are the normal sort of minimums with Alliant? And if you're recommending having a lot of different accounts, how do people keep up with that?
Yeah, so I'll share how I've done that, because sometimes over my career I've worked for companies, maybe have done some side work and advising. So for Alliant, the only minimum balance is $5 in the savings, and if you join as a freelancer, we put that in for you. Our checking accounts, no minimum balance and no monthly service charge as well.
Okay.
Yeah, so that's a great way to not have to tie your money up in a bunch of minimum balances.
It certainly makes it easier, this idea where you're saying we should have a lot of different accounts.
Yes.
Yeah.
Yep.
Thank you.
Sure. Okay, so for me, I have pay coming in twice a month, right? So I divide my bills in two, and each time I get paid that whatever my monthly bills are, and I average up, right? So if I know that things are seasonal and one expense is higher during a certain time of year, I just budget for the highest number for the whole year, and that creates some flexibility in there for me. That account is simply for my expenses. So my play money I use for going out or for entertainment, that's a whole separate account that I spend out of. And when that money is empty, it's empty. I'm not pulling money from my expense account. It's not all in one big pile where I go, okay, I have mortgage or rent due Thursday. I get paid Wednesday, and I want to buy this thing today. Oh, I can do it. That timing game, right? That's where people get into trouble. But if I separate my money out that way from a personal standpoint, it's a lot less stressful. If my quote unquote play money account is empty, it's empty, but all my bills are paid. And I know, just from a psychological standpoint, if I decide to go dip into that expense account, I know something's going to bounce. Something isn't going to get paid. So that's one way to manage your money. Manage your personal finances and your business finances separately, but run them both as a business and separate it out like you would in your budget and your spreadsheet. So creating a budget. So we were just talking about this, creating a budget on an irregular income. You can expect that irregular income to come in, but you just don't know what your amounts are, right? So what is my standard of living there? Well, if you've been in business for a period of time, you can take those averages out and try and live off of what some of your lower months are. Now, you might say there's a 1 month and that month was crazy and I was away, or I had an issue, something happened in the family, I couldn't take jobs. Well, push that one out of your numbers, but live on the lower end. And there's going to be a strategy here that I share that that will seem ambitious, but if you can do it, I think it's a strategy to success. All right. So how are we going to manage those monthly fluctuations? Here's how we can do it. The strategy is simple, it's effective, and it's to fill two buckets at once. And so let's use this year and next year as an example. The goal is to try and earn as much of your 2019 income in 2018. The benefit to that is that when 2019 comes, you can establish your standard of living at the beginning of the year. And the money you make in 2019 is either going to fill the gaps, right, of what your standard of living needs to be. So if you're saving now, at the end of the year, you don't have enough to live on in 2019, your 2019 jobs are going to supplement that. And then whatever's left is going to go to the next year. So let's talk about what happens if this isn't a perfect world, right? So let's say perfect world, you can live skin and bones, real thin on your expenses, and any money you make, you throw into this bucket for 2019. 2019 comes along, and you have enough money to live better than you did in 2018. Now, what happens there is that you just live off of whatever's in that bucket for the year. If you have a breakout year in 2019, guess what? You're going to have a breakout standard and living adjustment in 2020. So for that whole year in 2019, you're just living what was put in that bucket the year before. This evens out your income. It also creates some confidence in that when you're taking on work from clients, you don't have to take on a certain client if you don't want to. Now you might still be in a situation where you need to financially, but as this plan gets set up and starts working, you can have confidence in knowing that I'm going to work with the people I want to work with. I'm going to take the business I want to take, and you're not going to feel desperate to take a job that might not work for you.
So Mike, just wondering, with these two different buckets for the years, are you thinking in terms of this is what you're doing with your business accounts, or is this what you're doing with your personal accounts, or how do you keep those sort of savings separate, and how are you thinking about that?
Yeah, so I look at it as, if you're running your business, you're running all your expenses, you're running all your income, your revenue and expenses through your business account. Whatever's left over, now obviously accounting for money for the upcoming expenses in your business, you're going to be paying yourself income over into your personal account. So that 2018 is going to be your business bucket, that 2019 is your personal bucket, and you're going to put money aside. So eventually, the goal here is to not be living out of your business account for your personal expenses, and to have that money separate, almost as if you hired yourself in your business, and you're kind of almost W-2ing yourself.
So do you recommend taking regular amounts out of that business account, or trying to not touch the business account for as long as possible, or how do you manage that transition from moving money from those business accounts to personal accounts?
Sure. So I'm going to dive into a little bit of that in a bit here, but for now, what I'll say is that you want to try and set it up so that you're regularly moving money from that business account over to the personal side. The tendency will be to just reinvest that money in a business, and if you need to do that, I get it, right? You got to keep the business going, you got to keep it growing. But you need to set the habit early that you pay yourself early on. That's the only way this is going to work long term, is if you find a way to separate your business finances and your personal finance. So I say regularly moving that money over to do it. And I'll give you an example, and this might work for if there's freelancers out there that that still may work for a company, or they have a longer term contract with the company. Maybe they're doing work consulting for a whole year, and then they're also taking some other jobs as well. They could live off the one job, or if they're still working, then the freelancing stuff is on the side. That money earned could be put into the bucket as if it doesn't exist. And then once that is enough, you can say, you know what, I'm no longer going to work for. I'm working for this company and I'm freelancing. I'm no longer going to work for the company because the money I've earned is saved. And now I can go into 2019. I can quit the job and freelance full time. So it's a great strategy for somebody doing that.
And we have some freelancers asking about timing. Some clients might pay monthly, some clients pay quarterly, some clients you don't know when you're going to get that invoice paid. How do you try to manage that variable income, or just income coming in at different times where, not being a traditional employee, we don't know that it's coming at the end of the week or every 2 weeks. So how do you how do you try to understand and then plan for all these different payment schedules and times?
Yeah. Well, unfortunately, you have to wait for a month where a lot of it comes in, right? So it's that month where everybody seems to be paying, or the payments fall on a high note, and then you start it from there. You don't want to do this when your billing is out and you don't have anything coming in. This isn't the right strategy to start then. It's when you have a little more money than your expenses, that's when you're going to start. Unfortunately, you're never going to be able to fully even out the income until you have a couple months worth of expenses saved. So that would be part of the goal too, is okay, maybe I implement this strategy when I say my monthly expenses are X, and once I have 3 times X, then I'll throw this strategy in place, because that 3 months, that 1 quarter will even out, right? So I have 3 months of expenses. I have 3 months to get work done and get revenue in, and that should help you even it out a little bit more too.
Okay.
Yep.
Thanks, Mike.
Yep. Okay. So here's if that strategy is a little too much for you right now, if that's not where you're operating in, right? Maybe that's not the ring you can grab at the moment. Let's take a look at another strategy, and that would be setting up 3 types of savings accounts. And these are 3 types of savings accounts every freelancer should have. One would be emergency funds, which we just spoke about. And at minimum, you want to get to a point where you want to have 3 months of those expenses, ultimately shooting for 6 months of your business expenses saved and personal expenses saved. Now, that is typically a large number. So when I've advised people from a personal standpoint and a business standpoint, I just say, let's shoot for a dollar amount first, regardless of what it is on a monthly basis. So that might be, for somebody who has nothing saved, that first one's going to be $1,000. Let me do whatever I can to get $1,000 in there. Then do whatever I can to get $2,000 in there. And I'll tell you, once you hit that first 1,000, now it's a habit, and now it becomes part of a game that you're playing, a good game, right? Like I've hit 1,000, I can do it. I found ways to do it. How can I find ways to get to 2,000 faster than I did 1,000? All right, and then we also want to look at the hills and valleys account, and this is where we have the fluctuations, right? March was great. April, my timing on work means payments aren't coming in this month as they were last, or the clients I have are slower payers or pay on a different cycle than the last group. How do I account for that? Well, you want to start filling that as well. With the good months, you want to shift some of that money over to that account, right? So if I need $5,000 a month to survive, and I get a month where I have $7,000 come in, maybe I kick 1,000 over to my emergency fund, and I take the other 1,000 over to that hills and valleys account. And when I say this, you're obviously, maybe it's not so obvious, but for me, when I say I have 5,000 coming in, I would count that as I have 5,000 after I have accounted for taxes. And so whatever your calculation is for taxes, you're going to shave that off of what you have coming in. So if 5,000 is coming in and you're going to push over $1,000 for taxes, then move that over to your tax account. You just don't want to have to worry about each quarter or at the end of the year having to come up with this, because ultimately,
when you're planning on what you need to come up with, I've heard some numbers. Is it 25% or 30%, or do you play it safe and try to put even more than that in that tax bucket? I'm not sure how much to put away in the big picture when a check comes in.
Yeah, I think it's going to come down to the type of business you're doing. If it's a business that has a lot of expenses in there, a lot of things where you're going to be writing off, then maybe you could go a little less. I wouldn't do anything less than 20%, but I tend to tell people to go a little higher. I'd rather at the end of the day, when taxes are filed and you write that check, that you go, oh man, I have this money in here. What do I do with that? That's a much better problem to have than, oh man, I didn't have enough in there. Where do I find the extra $2,000? So I would tend to go maybe towards the 30% number.
Okay.
And that's all. That's all going to come down to how you're pricing your work, right? So if I'm accounting for that earlier on in my pricing, it becomes easier to do. If I'm saying I'm going to go price this job and this is my hourly rate, and I price it, and then I'll worry about taxes and how that affects my expenses later, you're going to run into this problem more often. But if I'm doing work where I can actually say, okay, here's the product or service I'm going to provide, here's my cost to provide it, but my other costs in there are also my taxes and how much I'm going to save as well. That's part of my margin. It makes budgeting a lot easier. So I always tell people to get saving for taxes, emergency, build that into your margin if you can, and still be competitive. But those are things that you're going to have to do early on. A great example of this is if you go to a successful restaurant, everything is accounted in that price for a dish. They've accounted for employees, their taxes, everything is a line item in that dish if they priced it properly. The restaurants that don't do well are the ones that just set prices and they randomly go and they never account it for food cost or their employee cost. So that translates over to what you're doing as well as a freelancer. If you can find a way to do that, you'll find some success there. So, and remember, all savings accounts are not created equally, right? The largest bank in the country, I think, David, starts similarly. It starts, the end of the name is a country as well.
Okay, in North America?
In North America, yeah.
Okay.
Their savings rate is 0.01%, right? So compared to like Alliance, 1.5% is our basic savings rate. Now, I bring that up because it takes more than just going through the behaviors here, right? Just going through the process of, oh, I need to save for emergency funds, I need to save for taxes, I need to do X or Y. You need to do it well too. It's your income. It's your money. How do you maximize that? You're doing that on the business side, right? That's probably what that's part of your value proposition to your client. I'm not just going to do the work, I'm going to do it well. Well, then do that for yourself on the personal finance and the business finance side too. How do I eliminate fees? How do I drive more revenue off of my money? And that could be saving it in better places or investing it in better places as well. So don't discount that, even if it's just a small amount. Act as if, right? Act as if you have the money you want to accumulate already. And how would you manage that now? Because the money habits are hard to break. You know, they're real hard to break. Once you're in a mode of spending, it's hard to get out of it. So I'm sure everyone here is familiar with the concept of net worth. So I'm not gonna walk through each step of that here. But many of the freelancers or business owners I've advised over the years began their business as a way to build wealth faster than they could if they had a regular job, right? So unfortunately, the business gets to a point where they're feeding that business instead of the business feeding them. Your business services or products are primarily business assets at this point. It generates you income. As with personal assets, it's important to consider diversifying those business assets as well. When I was a financial advisor, one of the other advisors in the office used to own a furniture business. He had 13 stores across the Philadelphia area, and one of the things he did was he sold off the business. He was done with it, but he held on to the real estate for all those stores. He sold off to a big national furniture provider, but he wanted to keep his income streams in different places. He became a financial advisor. He had some other businesses set up. And he thought, how can I still generate income off of my furniture stores? Well, I'll sell the business and I'll hold on to the real estate. And that's what he did. But one of the things I learned from him as being a colleague is the advice he always gave to people was, if you're a business person, don't get locked into just that stream of income that you're getting as a business person / freelancer, right? Find other ways to develop income off of this business. Now, for instance, I can think of two immediate ways here. One is there part of what you do for your clients that you could do for other freelancers, right? Is there this part of your business that's process oriented that other people would pay to have you do? If you're a little slow, you could take on that extra work and do. And then the other part is looking at your own business processes and thinking, is there ways to streamline this or outsource it so that I can go do more of what I want to do to generate income? But that first one is there more than just what I'm doing client facing? Is there something along my process that I could sell to other freelancers as a service? And now you're generating two streams of income off your business, and maybe that's the one you use to save. And then from there, transferring to personal wealth, what are you doing with that personal wealth? Is it going to sit in a savings account, or is there other things you can do with that income to generate income? That could be investing. It could be investing in mutual funds or real estate or whatever it is that works for you. You want to start diversifying that. And part of that's going to be looking towards retirement, and I'll dive into that as well. But I can't emphasize enough doing all of this from the beginning. And if you've already been in business for a while, doing it from right now, moving forward, getting the habits in place, regardless of the dollar amounts.
It sounds like step one you're saying then is just, let's keep it simple. Have your different savings accounts. Try to put money at first into emergency. And if you can, get a savings account that has a higher interest rate, so at least you're getting something.
Exactly.
And that's like first step. Let's see if we can get $1,000 in there. Because
Right.
I mean, a lot of freelancers are either just starting off, they've just made that leap. So there's definitely a transition period where you're trying to figure things out and move from getting by to getting ahead. So
yeah,
save it, small amount, get to that $1,000 in that emergency account, high interest savings account.
yes, exactly. Step one is get your plan in place, keep it simple, make it actionable, and then execute on it even at low dollar amounts. Because this plan will work when you get to larger dollar amounts. So you don't have to worry about doing this all over again. It's going to lay the groundwork for success later on.
Okay.
Right. Okay, so to talk a little bit more about how to allocate that money on your day-to-day money coming in, you should keep that checking account lean, right? Enough to cover your monthly expenses and then some wiggle room there if an expense comes up that you weren't accounting for. But outside of that, you should be either shifting money into your business savings accounts for what you have budgeted out for the year and for future expenses in the business, and then what you're kicking out to your personal income for the year. And once again, as early as you can, you want to start separating the two out. And I get it. It's going to be really hard in the beginning to do that. But the more you can do that earlier on, the easier it's going to be later. All right, let's talk about liabilities for a moment here. So we looked at the asset side. We've talked bigger picture about net worth. I want to talk about the liability side because you're ultimately going to want to grow your business. You can do that through saving. You can only save so much based off of the revenue you have coming in, right? So almost every business owner who has any level of success reaches a point where they have to decide how to expand their business. Now they can do it slowly and methodically. As income comes in, they allocate it and they grow it, but they might get to a tipping point where they have to borrow. Now, and you're going to be pulled in different directions here. As a former financial advisor, I was always a little more forward thinking in planning for where the business is going to be next year, 2 years from now. And even as a business banker, same thing. Your tax professional is looking at last year. How can we find ways to save you money in taxes, and then what are we going to do this year to give you some advice so we can save you, so this time next year we can save you money on your taxes as well. These two pools are not always, they don't coexist well sometimes together. So one of the things you want to take a look at is, where do you want your business to be? Am I going to save for it, or am I going to borrow for it? And if you are going to borrow for it in the future, you're going to have to consider showing income to be able to borrow. Having spent years and years in banking world, either with a credit union or one of the big banks, there's always this frustration from freelancers, business owners, when they would sit down and they would say, I need to buy equipment, or I need to buy office space to expand my business. And I'd say, okay, well, let's take a look at your tax returns. And they say, well, here's my revenue that I've generated. And they say, well, where's the net income? Well, I don't show any. My accountant's trying to save me money on taxes. And I get the urge to do that. But you can only save so much early on. You may need to borrow. You need to start preparing for some of that by, one, saving, but also consider being okay with showing income. Now, that's ultimately going to come down to you and your tax advisor. But as someone who worked in the business lending world before, they're going to need to see income over about a 2-year period for you to borrow. And even in the beginning of your business, that's going to have to be borrowing that might be leveraged against you personally, right? So it's a credit card in your name, or if you own a home, it could be equity in your home.
So
yeah,
when we're thinking about doing that borrowing, because obviously all the business expenses fall on us as freelancers. We got expensive, in a lot of cases, we've got some graphic designers, some photographers, some videographers who are in the chat here. That's expensive equipment to have to buy and maintain. If someone's going for a loan and say they've had profitability over the last couple of years, do they also need to be incorporated? Do you have to have an LLC or an S Corp, or with income as a sole proprietor without that legal structure, can you still get something that you'd call like a business loan? How does that work?
So typically, if you're a sole proprietor, there's going to be some type of personal risk associated with your borrowing. So it's going to be based off of your income, your personal credit. When you do incorporate, then you can start establishing credit under that business and borrow through that. Now, that's gonna, when you do that though, you take the risk away from your personal assets, right? Which is always a positive. But it's a harder goal to jump to.
So that's the difference between, if you're a sole proprietor, the loan might look at holding your home or your car as collateral, but not if you're a business.
Yeah, or if you have a credit card, it's going to be under your social security number and tied to your personal, it's going to show as your personal debt. Where if you're a corporation and you've been able to establish business credit, that's where it's pulled separately from. It can be separate from your personal assets. Not always. They still sometimes bring it in, but it can be eventually.
Now, so if you're then a sole proprietor and you have some personal debts like student loans, would you really need the business structure then to be able to keep things separate and get a loan? What if you have a lot of personal student debt or other type of debt?
Yeah, so it's gonna be lender by lender in how healthy or big your business is, how much they want to pull in your personal side. The other thing you want to consider here is that there's a reason why sole proprietor is something that's used a lot earlier on, right? It's much more cost effective, right? The barrier to entry there isn't as high. Maintaining a corporation, filing tax returns, paying for all that can get expensive. But you're going to need the income inside of that corporation generated to be able to borrow off of. And earlier on, even with the corporation, they're going to see some personal assets to counter that.
Thank you.
Yep.
Yeah, we had some folks. Well, we had one person asking, but I'm sure a lot of people thinking it. So
sure.
Appreciate it.
Yeah, there's going to be a gray area between that sole proprietor and corporation. There's going to be this gray area in between where you're going to have to. It's going to be a little bit of both business credit and personal credit. And then once you've established your business and have some credit, then you can leave the personal side behind.
Thank you.
Yeah, sure. And their student loans, they don't hide from anybody, do they?
Can't get around collections.
No. All right, so let's get back into the areas in your personal wealth here. We discussed the benefit of general saving and the security it brings, and the importance of doing that at whatever level you're at now. Right. So if you're able to throw a couple $100 a month aside, great. If you can't, and it's $20, you might think it's ridiculous. You might think it's not worth it. It is absolutely worth it, because you'll wake up 6 months from now and you're going to have some money sitting in an account, and then you're going to, to allude to what I said earlier, it becomes a bit of a game. I did this. How can I do more? And then talking about increasing the value of your business success and stability, that's going to come through managing your expenses, and that's going to come through money management. That's going to come through, how do I allocate from my expenses? How do I level out these hills and valleys? Am I am I in a position to use that 2-bucket method? If not, am I just separating my accounts? And then anytime there's a little more than the standard of living I've set, I bump it over. Either way, that's going to help increase your business success by having some financial stability. And then the other part is retirement savings. This is a huge issue for a lot of freelancers and business owners. They spend so much time building that business early on that they put this on hold. And I get it. At different times in my career, I've been there. But the sooner you can get back to this, the better. Because ultimately, you don't want to be in a position where the only asset you have is your business. Because if you're no longer able to do business, if there's a disruption in the marketplace that makes your business no longer viable, now you're really stuck. And also, from a health standpoint, what happens if there's an injury or a disability? You might have a service that you provide that you think isn't an issue if you threw out your back or you blew out your knee. But I had a client who, to use this as an example, I had a client who was an adjunct professor at a college and was presented with the idea of putting money off to the side or having insurance to protect income, and decided against it. And she had a massive stroke. Now, because of that stroke, she lost her short-term memory, which prevented her from being able to be talking about a point in the class, turn to the board to write a note, and then turn back and remember what she was saying to people. She effectively lost her ability to earn income. That can happen in different ways from a business standpoint. So when I say retirement savings, I also should say finding ways to fund protection of your income as well.
So Mike, as we're talking about savings, I know a question that comes up for a lot of people, when you have different types of debt, like credit card debt or student loan debt, or a mortgage, should you be putting that money into retirement, or should you be paying down debts? And how do you look at the decision-making process there? I mean, can you put anything into retirement if you're still paying down big debts?
Yes, you can, and you should. It's all going to come down to how critical that debt amount is and how critical it is to your monthly expenses, right? If it's eating up everything, maybe we want to focus almost entirely on that debt and getting it paid off. But I would say sooner rather than later, you want to be able to do both there. So, and there's some strategies that you can put in place on the debt side that'll free up money for your retirement side. So here's one, for example. Anybody who either listens to Dave Ramsey or Susie Orman, and they talk about paying off debt. Here's the simplest strategy, and when you do the math, this always works out to be the way to go is you want to find out who's charging you the most, right? Everyone else, you're just going to pay your minimum payment on. And then whoever's charging the most, any extra money you have, you're going to put towards that bill. And then once that's paid off, you're going to take that extra you were paying plus that payment you were paying and add it to the person who's charging you the most interest next. And that's how you're going to work down the line. It's snowballing your debt. And then the other term to keep it winter themed is snowflaking. And a lot of that is there's people who either yard sale or do side work, and all that money is just automatically earmarked for debt and paying it down. The beauty of that is once you get
Mike, I appreciate the winter themes for all of our friends here from Chicago and Detroit and the Midwest and most of us in the Northeast. So good job sticking with those.
Okay. Yeah. And then once you free up one or two of those payments, you can decide, do I free up a little bit of that cash for retirement, or do I keep all of it towards debt repayment? I would suggest that you seriously consider setting up retirement as soon as you can. The compounding interest, you can increase rate of return, but you're increasing risk. The one part of that component that is the most valuable and you cannot recreate is the time. So the earlier you start, the better there. Even at the sacrifice of not paying your debt off sooner.
So the setting up retirement, ideally, we should all make the maximum contribution every year from when we first have a job until we're ready to retire. But if you open an account, can you put in $200 because that's what you have right now? Or are there limits or minimums?
It depends on what you're saving. It depends on who you're saving with, right? So if you're looking at mutual funds and investments in the beginning, there are minimums for lump sums in there. So some of them are $1,000 or $2,000. But the way around that is if you set it up to be an automatic withdrawal on a monthly basis, a lot of those investment firms will waive that minimum. So as long as you're doing it consistently on an automated monthly deduction. So that's something to look for earlier on. So don't let the $100 or $200 that's all I can do prevent you from saving for it. Does that answer your question?
Yes, thank you.
All right. So let's pop over to retirement there. Make retirement a priority from the start. And that doesn't mean that you do it at the expense of everything else, but it certainly should be a component as early as possible. And as a freelancer, you want to identify which of the tax preferenced as opposed to referenced resources work best for you, and then contribute consistently. There's two reasons you want to contribute consistently right off the top of my head. One is you're creating the habit, and two, you're taking advantage of what's called dollar cost averaging. So if I'm contributing every month, 1 month the investment's doing well, the price is high, I get less for my money, less investment for my money, and then the month that it's low, I get more. Over the course of a year, you end up paying a lower price on average than you would if you threw in lump sums at various times throughout the year. And once again, this should be viewed as an expense item. So you want to look at it in pricing in your margins. So let's move along in the interest of time here. The retirement, let's look at those retirement savings options. There's a SEP IRA, the Roth IRA, and that solo 401k is out there. I'm sure many of you, if you've explored this, are familiar with it. But the SEP, currently you can contribute either 25% of your net earnings or $52,000 a year, whichever is less. So those contribution limits are a nice problem to have, right?
So, that Roth IRA, that's sort of the standard one that I know we've recommended a lot at Freelancers Union. We've talked about when it comes to tax policy and making that year-end contribution. Personally, I haven't heard of the SEP IRA or the other 401k, the solo 401k. Mm-hmm. Could you just give us a little bit about how those are different and what type of freelancer you need to be to contribute to those? Is it have to do with the business structure?
So all of these can work with the different business structures. The Roth is more tied to sole proprietorship, but the SEP it's called a simplified employee pension IRA. The reason somebody would do this is they want to contribute more, right? A Roth IRA has a lower contribution limit to it at 5,500 for the year, the last time I looked, where the SEP IRA is higher at 52,000 a year. So if you want to be able to contribute more, you're looking at the SEP. Now, that's something you get a tax write-off now, and it grows tax deferred, and then you pay taxes when you withdraw the money in retirement. The reason the Roth is so appealing, especially if you're on the younger side, right? So the Roth, you don't get the tax write-off today, but it grows tax deferred, and then when you pull the money out in retirement, you don't pay taxes. It's not shown as income in retirement as it's currently structured. The solo 401k allows you to contribute as an employee, an employer, and an employee. So as your business gets a little more successful, and maybe you're starting to bring on some people, this allows you to use your business to pay you a match, which you miss out on as a freelancer right now because you don't have a company matching your 401k or retirement savings. This allows you to create it in a way for yourself. And once again, that's going to be a higher limit as well. But yeah, based off of what your demographics are on the freelancers, if they're on the younger side, you're probably going to lean towards more the Roth, because long term, I'd rather pay taxes today on $1,000 as opposed to when it turns into $10,000 20 years from now. Okay. Hopefully, when it turns into that, right?
Yeah. Thanks for the info.
Sure. Be prepared. We talked about protecting your income. Work to be the best, but be prepared for worst case scenarios. Having that emergency fund. Start with 1,000, shoot for 2,000, shoot for 3 months from there. And then be prepared for retirement. You'll need about 75% of your current income in retirement. I always told my clients, if you just want to replace your income, so let's save more. A fair rule of thumb is if you look at the bulk amount of the total balance of what you have saved for retirement, right? This is a good way to indicate where you're at today. Take 4 to 5% of that number, and that's what you could pull from it each year and survive in retire and not have to worry about running out of money. So if I have $100,000 saved, I might think, oh, that's great. But if I take 5% of that, it means I could pull $5,000 a year and not have to worry about running out of money in retirement. Could you live off of $400, $420 a month? No. So you have to save more. So that helps you put in perspective how big your retirement goal should be and how early you should start on it. So, this is going to come down to balancing multiple financial and business needs with a simple approach. Whether it's the bucket approach, whether it's setting up a couple accounts, it all comes down to how do I separate my business and my personal assets as early as possible? How do I work growing my personal wealth into my business margins or my business margin, considering it as an expense, just like I would my software or equipment? I need to consider retirement and general savings expenses as well in my business and price appropriately. Getting these systems in place early and simplified as well is the best way to go. I tell people you do a full detailed budget once a year. Really nail down what you think is going to come out. Look at your past bank statements and nail it down. And then from there, come up with the simple plan. Like, okay, here's my monthly amount. Every time I get paid, I need to contribute up to that amount and move on. Don't try and do that complex budget every month. You got to use the budget and figure out what your system is based off of how your income comes in.
And I guess the budget might seem simple, but I've been in the same position, and I think a lot of freelancers are also, where we don't always know what our take-home income is.
Yeah.
It's easier to see the big number coming in and forget what it actually is after you minus out all those expenses. So maybe that sounds simple, but I know that's been a challenge for me.
Yeah, for sure. And when you price it, when you start looking at it as those items as expenses, when you're pricing out the work, then you can start looking at it at a more micro level and saying, I have 6 jobs out right now, and that equals this much income, as opposed to waiting for all the income come in, pay out all your expenses, and figure out what's left over. if you know what each of those jobs will bring you net in the beginning, that's going to help you start to budget a little sooner. It's not a complete resolution to the issue. You're always going to have the ups and downs, but the earlier you know what that number is coming to you, the better. So I want to thank everybody, and I'll obviously open it up for questions with the time we have left here. But once again, one of the resources available to you as a freelancer is Alliant Credit Union, and those benefits include higher interest rates on deposits, lower rates on loans, and personal services there that make it more convenient. You're busy, and you're all over the place, so we try to be everywhere for you as well. And people are noticing, and organizations are noticing as well.
So just one broad question that I've been thinking about here, the saving better is a great problem to have. For a lot of freelancers, either you're just getting started and you're trying to catch up and build a business, and savings isn't an option at this point. A lot of other freelancers are in this as necessity and not choice. We might freelance because we weren't able to get a full-time traditional job on our schedule. So that savings is a good problem to have. But as we're trying to get our feet under ourselves and under our business, what do you think as a financial advisor is like the amount of time you should be taking in terms of years to build that business before you might realize, do I need to make a change? Do I need to do something different? Like, what's a normal business growth period to getting to a point where we can save?
Yeah, well, one, it's gonna, and not to dodge the question at all, Dave, but it is gonna depend on the type of business you're building, right? If it's a service, like for instance, photography, for example, if you do well, right, that explodes pretty quickly, right? The referrals and the word of mouth spreads very quickly, versus another service that might have a longer sales cycle to get the business in the door, right?
Okay. So it really depends on industry, in your view.
Yeah, but overall, there's different phases in the business. So there's the startup phase, and that's going to be characterized by extreme ups and downs in business and income and expenses. And then there's going to be this transition to the hills and valleys are a little tighter now. They're not as high, not as low, and there's still steady money coming in every month. That's the first line across, and then from there, it's expanding without having to go back into that up and down again. That's one of the big parts, is those three steps, and you'll know when you're in that first one, right? And if you're in there 2-3 years, you have to really evaluate your business plan and how you're pricing and managing money, and how you're prospecting and selling to get business in the door. Yeah. But once you get into that next phase, the trick is getting from the medium to the how do I expand this without taking on a ton of debt.
Yeah, we're running short on time. And I'm sorry we didn't get to too many questions at the end here. I think the presentation was great, and we were able to get to a lot of questions throughout. So Michael, thank you so much for joining us today and taking your time to help Freelancers Union members. And members, there's links below for more info, so you can find out more about Alliant, the services that they offer. And this YouTube video is going to be live sometime later today, so you can share it within your network. So members, we're independent, but we're united. We're all in this together. And if we don't make freelancing better for ourselves, then who will? So thank you all for being a part of the union. And thank you, Michael.
Thank you.